Welcome back to Witness Richness. It's your boy JCP back with another video. And this week, we're going to take a few steps back and go over some basic real estate vocabulary. Now, I know I made plenty of videos talking about equity and all the passive income, but this week, I actually want to define each one of those words and give you some real life examples so you know exactly what I'm talking about, and I can make sure that we're on the same page as we're growing together. Let me break down a few more words, take off this intro, see you in a minute. So as you can see, I'm back at the whiteboard. And before we get into these vocabulary words, let me first explain to you what motivated me to make this video this week. I actually met with a family on Thursday as we were discussing some financial strategies and some real estate strategies to build a real estate portfolio for his family that he wants back down to his children. So I met with him at Panera Bread, and we talked. It was a father, a mother, 19-year-old son, and a toddler daughter. And as we're talking, I'm talking residual income, passive income, generational wealth, equity, down payment, and you know, I've been in real estate for so long now that some of these terms to me are just like common knowledge. But when you're talking to a 19-year-old college student, they may not understand these terms. And they may have heard these words, they might have heard these words before, and that's why they shake their heads like, yes, they kind of understand things. But what happened was, in between, you know, my breaths, I can go on, right? When I talk about real estate, I get really excited. He would pause, he would look at his son, he would say, do you understand what he means when he says this? And the son looked at him and said, like, yes. Then the father would ask him, what does equity mean? And he would say, like, he doesn't know. And then he said, the father looked at his son again and said, what is residual income? His son again said, I don't know. Like, he just couldn't define the word. I'm sure you heard it before, and he's actually familiar with the term, but he couldn't define the word. Which, once you can define these words and you actually use these words, it makes a lot more sense going forward. So I would suggest that as I go through these words, you pause the video right now, get a pen and a paper, and any words you can't pretty much see and define and give an example of, then maybe you should write this thing down. Because listen, if you really want to learn and apply this knowledge, you're going to have to get familiar with these words. It makes things go a lot smoother at the closing table. So let's get right into it. I'm going to go over these words in the sequence as if you were going to purchase a home, what you would need to know as you go along. But these words are not written up here in any particular order. So as I explain these words, I'll check them off. Okay? So down payment. A down payment is money that the bank will require for you to put down to purchase a home. Usually, a down payment would range anywhere from 3.5% to 20%, depending on the type of loan. Now, if you want to get a 3.5% loan, that is most likely going to be a FHA loan. So down payment is money you put down. Let's check that off there. Wow. Okay? FHA means Federal Housing Administration. It allows first-time home buyers or a primary residence on a mortgage to get a low down payment, which is 3.5%. The reason why it's 3.5% is it's backed by a PMI. Now, PMI is private mortgage insurance, which means every single month you pay an additional couple $100 to protect the bank in case you fail in that loan. The bank will actually still get paid on that private mortgage insurance. So that's FHA. Fair Housing Administration. Will give you a 3.5% down payment in return for you paying a PMI, which is private mortgage insurance. This is gonna be a good one. All right. Now, going forward, before you buy a property, the banks will want to make sure that that property is worth the money. And the banks don't know pretty much if it's worth the money. They will hire a professional appraiser, and the appraiser will come out and give you an appraisal. So next we have the offer to purchase. That's just a document that you're going to give to the seller saying that I want to buy your property, and these are going to be my terms. Okay, that's just the offer to purchase, and it can get declined or it can be approved. Now, if you put in an offer to purchase you're going to want to put in an inspection contingency, which means usually it's 5 to 10 days. You want to get that property inspected before you go into a purchase and sales agreement. Now, the inspection contingency just means that you're going to hire a professional inspector to come out to the property and look at everything from the foundation to the roof. And a lot of times, these inspectors these days, they have drones. So they can actually have a drone go on top of the roof and check everything out. The inspection is like not mandatory from a bank, but for me to you, for the extra couple $100 that they can do for you, I would highly recommend you get an inspection. And then if you watch any of my previous videos, then you would know that that inspection that cost you a couple $100 can be leveraged to save thousands off that deal. Meaning, if you get that inspection report, right, and you go through it with a fine comb, with a light comb, and you look for everything that's wrong with that property, or anything that you want fixed, you find it with that inspection report. So definitely get that, okay? So that's the inspection contingency that you should put in on that offer to purchase. Pop, checking off, moving on. Now, if you get the inspection, and you go back at the seller and you say, hey, listen, I want you to fix this, I want you to fix that, and pretty much once everything's agreed upon, that is called the, where will be at here? Don't know it up there, right? Purchase and sales agreement. That purchase and sales agreement is now saying that we put in an offer, you accepted it, I had the inspection, we signed the purchase and sales agreement, now we have a closing date, which means that the closing date is the day that you're going to sign paperwork and transfer the deed and the title and whatnot. We'll get more into that a little later on. Now, inside of this purchase and sales agreement, as a consumer, you want to make sure that you always put in a mortgage contingency, which just means that for some reason, you can't get approved for a loan after you've already been pre-approved from the bank, that you can back out of that deal and collect your earnest money deposit, which is your money you gave to the seller to hold the deal in place. It's almost like a deposit on a car, right? If you want to hold the car, you put down a couple $100. That's what the earnest money deposit would be. You want to make sure you put in a mortgage contingency so you get that money back. Because if you don't put in a mortgage contingency, and let's say you put down like $1,000 or $5,000 as an earnest money deposit, that money may not come back to you if you don't have a mortgage contingency in there. So put that in there as well. All right. Now, going back to FHA, which again is the Federal Housing Administration, those type of loans usually only allow you to have a residential mortgage. And what a residential mortgage means, it's a mortgage that you're taking from the bank stating that you will live in that property. And the banks usually only give residential mortgages from 1 to 4 unit buildings, okay? 1 to 4 unit buildings. Now, if you're rocking with this channel, I'm always going to suggest, unless you're buying that dream home, that you get as many doors under one roof as possible, because you decrease that liability, you decrease that chances of you not making that cash flow, all right? And seeing that I just said cash flow, let's get right into cash flow, which is right here. And I do, at this point, if you're watching my channel, if you subscribe to this, I do expect you know what cash flow is, because I've broken it down in plenty of videos before. But cash flow is all of the income from the rents, from the laundry machines, from the signs on the building that you can put up, from the extra storage you put down in the basement charge for the tenants. All of the income, subtract all of the expenses, is the cash flow. That's a simple concept. And the cash flow is the reason why I am a buy and hold investor. Buy and hold, which just means I buy property, I collect the rents, I pay the bills, I keep the difference, which is my cash flow, aka profit. Now, let's get into it. Investment loans. Investment loans or investment mortgage is going to be 5 units plus, okay? And that's considered investment or a commercial loan. And because it is considered a commercial loan, you can actually be more creative with that down payment. Mortgage. Let's talk about mortgage. Mortgage is the actual financial document that you sign with the bank that states you will pay back all of the money they let you borrow to buy this property plus interest. So you're paying the principal, which is how much money they let you borrow, plus interest. That is the financial agreement, okay? That's what the mortgage is. Let's check that off as well. Now, that mortgage will have the principal plus interest, and typically a mortgage will be amortized over 30 years, But you can always elect to have 10, 15, or whatever you feel comfortable paying on a monthly basis. You can actually have that amortized over whatever time frame you choose. But typically for residential property, as an investor, you choose to extend that out. It actually increases your cash flow when it's extended out. But that is the mortgage. And when I say amortized, okay, understand that you have an amortization schedule. And what that means is when you're paying back that loan every single month, how much you pay on the interest and how much you pay on the principal changes every single month over the course of that 30-year span. Meaning, let's say the mortgage is going to be $1,000 per month. There's a good chance that with the amortization schedule, which the bank will provide to you, you would see that the first 10 years, most of your payments of that $1,000 is going to be pure interest. So to break it down in some actual numbers for amortization schedule, which the banks will provide to you, I'm going to give you an example. Your mortgage payment may be $1,000 per month, but for the first 2 or 3 years, you may be paying $900 a month in just interest, and only $100 a month out of that $1,000 would be counted towards the actual principal. You understand that? If not, pause the video, rewind it, go over it again. That's the beautiful part about YouTube, right? So listen, the amortization schedule will change. Over the first 5 to 6 years, you'll be paying mostly interest on that $1,000 a month. And then over the next 5 to 6 years, you'll be paying mostly interest on 5 to 6 months. Maybe around year 10, usually on a 30-year amortization schedule, you'll start paying more and more principal and start to change. But pretty much on these loans, the banks want their money up front. So that's the amortization. Going right into it. If we talk about mortgage, let's talk about the promissory note. Listen, the mortgage is the financial document, but the note or the promissory note is an actual document that you sign with the bank saying that I promise to pay you back this money. And that's pretty much all it is. When you go to get a mortgage, you'll sign on a note, all right? Let's talk about deed, okay? The deed is the actual documents that show the transfer of title. So a lot of times, you'll sign a deed, and that deed has to get recorded at the county registry of deeds for that particular state or county. So that's what the deed is. The deed shows the transfer of title. Now, if we're going to talk about title, that's right over here. Title is the actual document stating that you own that property, okay? Or, like a car, it's the actual document saying that you own that vehicle. That's the title. Anytime you go to finance a property, the banks will run a title search. A house, a property can be held in different kinds of titles. But we're not going to go into all the quick claim, quick deed titles. There are different types of titles. I don't want to go too far into all of that, but make sure the bank or the financial institution does run a title search on that property before you buy it. It does protect you, and also I recommend you buying a title insurance policy when you buy your first property, or when you buy property at all, because that just ensures that no one else can make a claim on that title on that property. You have insurance on it, which means that the title insurance will just protect you if somebody else tries to make a claim on that property saying that, hey, that property is mine, which could happen. It's rare, but there are different kinds of titles. But each lender or bank will usually do a title search. So that's title. And with the title search, the reason the banks will also do a title search is to make sure there are not any other liens or encumbrances on that property. Let's talk about equity. Equity is defined as the difference between the fair market value and what you owe on that mortgage, okay? If you have no mortgage, then the property is 100% equity, and whatever the fair market value is how much equity you have in that building. But if you have a mortgage on that property, then the difference between the fair market value and the mortgage is what your equity is. So let me give you an example. If you have a property that the fair market value is worth $100,000 and you have no mortgage, that means that property is giving you $100,000 in equity. But if that property has a mortgage on it, let me give you another example. The property is worth $100,000 and you have a mortgage on it for $50,000. The difference between the mortgage and the fair market value would be $50,000, meaning that in that piece of real estate, you have $50,000 of equity. Now, let's get into residual income and passive income. In real estate, these are almost the same, but understand that residual income is more like guaranteed money to come in with no issues and no problems, okay? So in real estate, residual income would be more like if you had put some money down into a fund and you was getting a solid return every single month. That would be residual income every single month. Every single month, money's coming in, right? Let's check out equity while we're here. And residual income, money that comes in every single month with the residual. And residual is outside of real estate. If you had a record deal and, you had a one-hit wonder, for example, and your music was being played over the radio, and it was being played over TV shows and commercials, and every time that music is played, you get a check. That would be like residual income. And you can get that in real estate as well. But in real estate, especially if you're starting off as a landlord, your income is considered more passive, which means you do little to no work, but the money comes in every single month still. So last but not least, return on investment, ROI. And if you're investing in real estate, then you should definitely understand return on investment, which just means if you put money down, how fast are you getting that money back? Or at what rate are you getting that money back? The rule of thumb usually for an investment, if you get your money back in 5 years, that is a solid return. Me, myself, when I'm investing in deals, I like to get all money back in 2 to 3 years. Those are the type of investments that I look for. Let me give you an example on return on investment. You purchase a property with an FHA loan, and you put down a 3.5 down payment. Let me give you some real numbers here. The property costs $100,000. You put down a down payment of 3.5 and use the FHA loan, and you put down $3,500. Cool. Now you realize that property will cash flow $1,000 a month. Meaning all of the income subtract all the expenses is a cash flow. So you realize that property is going to cash flow $1,000 a month when you only put down $3,500. So that means that in 3.5 months, you get all your money back. And from that point forward, it's all profit, which is a solid, very solid return on investment. Listen, all of these words, I did not fully understand on my first, second, or third real estate transaction. So I know this is tremendous content, and I really hope that you took the time to write these notes down and understand this so it can help you buy your first investment property or help you buy your first property in general. Don't forget to like, share, comment, and subscribe. And as always, my friend, I invite you, let's grow together. I'll see you in next week's video.